G'day and welcome to Motley Fool TV. I'm Adam Surplice, General Manager of Motley Fool Australia, and joining me tonight live is our Chief Investment Officer, Scott Phillips. G'day, Scott.
Adam, g'day. Good to be with you, mate. And tell you what, it's been a busy month this August.
It certainly has, and appreciate you giving up your time for this because I know how busy you've been. Just before we start, as a disclaimer, we cannot give personal advice, but we will do our best to answer any and all questions that you have. We've got a program to get through, but if you have questions or comments, throw them in the chat and we will address them along the way or at the end. Now, Scott, earnings season. Earnings season has been a very busy time for you and your analysts here at Motley Fool Australia. It's just wrapped up. Give us an overview of what the team found during a very busy reporting season.
That is a very good question, mate, and it's been absolutely chockers. I got to say, we love it. Like it's when you get to see what's going on. It's kind of all happening, and news is breaking. And on about 8:30 or 9 o'clock of a morning, your inbox starts to fill up with stuff, and you kind of know what your day is going to be like. It drops in and drops in and drops in. You think, okay, got a bit to do today. But it's been awesome, mate, because you get a real sense of what's going on. Couple of thoughts up front. Firstly, our approach. We've not tried to be the fastest, coolest kids in the shop, right? Investing is not about speed. It's about analysis. It's about thought. It's about context and perspective. And so what we've done is we've given our members some really great content. I've got to say, you mentioned the investing team. We work with some great investors, which is awesome. And they have done a welter of work, but they've done it thoughtfully, right? So not only, we're not trying to do the hot take thing. Anyone can do that. It's not very useful. We're trying to do the proper analysis thing. And that's, I think, gone pretty well. So that's been the way we've approached earnings season. We've got another 2 days to go. So I'm not going to call it over just yet. It's been a really, really interesting one, mate. What I think is fascinating is maybe the first thing is the impact of inflation. Now, we all know as consumers, we're paying more at the till, we're paying more at the pump. But if you think about companies themselves, we've had plenty of companies, retailers, but also other businesses that have grown their top lines reasonably slowly. Why? Because spending slowed down, right? We all know that's the case. GDP is slowing. We've spent our savings, and we might talk a little bit more about that in a minute. But what we've seen is companies' sales growth has been pretty anemic, but their cost growth has actually been reasonably robust, unfortunately. So there's seen quite a few businesses that have actually been able to do something at the top line, but have that swamped by the growth in their cost base. And that's kind of, again, not surprising. That's the other thing. You look at results, you say, what did I expect? What did I get? We didn't expect anything different because that is the environment we're in. But we've seen a lot of that. And for the first time in ages, even when inflation's been around for a couple of years, but for most of that time, sales growth has been pretty good. Why? Because we had lots of savings. People were spending up big. Even though inflation was high, the spending was covering a lot of sins. This time around, the spending wasn't there. So we've seen that. That's been one of the key ones. We've seen really interesting results for the banks. I want to say almost every bank went backwards profit-wise. Loan growth has been really, really tough to find. And what's fascinating, mate, is that up until this part of the economic cycle, for, 40 plus years, the orthodoxy's been when rates go up, banks make more money. Why? Well, generally speaking, you increase your loan interest rates faster than you have to increase your deposit rates. So you have this kind of widening gap, right? Yes, you pay a bit more for your deposits, but you charge a lot more for your loans. There's more margin in that space. We've actually seen the reverse this time around. Margins have been falling sequentially for years, but this, increase or this kind of tightening cycle, I should say, if you like, when the RBA has been tightening the economy by putting rates up, the banks have actually been going backwards in margin rather than increasing their margin. So that's been really interesting to kind of watch. Interestingly enough, businesses like Judo Bank, the non-big four banks that are taking market share, are actually doing relatively well by comparison. So that's interesting as well. And then, of course, we've seen resources companies all over the place, and plenty of people own those shares. What I thought was fascinating this week is BHP delivered a $20 billion profit, if you don't mind, 13.7 US billion dollars, about 20 billion Australian, but they actually cut their dividend. And this was interpreted by the market probably correctly as a sign that BHP is saying there's no more growth in what we're doing. We're going to have to go and dig more holes, buy more existing mines, buy more existing miners, and try to get growth that way. Now, that's got implications for the national budget, for the national economy, of course, but investing specifically, we're seeing, I think, the miners realize that maybe, I'm not going to call anything over. I don't do predictions, as our viewers well know, but it seems like the miners are coming to some sort of belief themselves that the best of days is probably past, and now it's time to go and find greener pastures. So interesting across the board. Retail and general slow growth businesses have done it tough. Banks really struggling with margins, and the resources companies trying desperately to find a way to get some growth. That's increasingly going to be, I think, buying new miners, digging more holes, rather than relying on higher volumes and higher prices from their existing mines.
Sure. Okay. So let's look at it. Let's zero in on one of the companies at the opposite end of the spectrum from BHP, a little company called Nanosonics, which we are a fan of here, and I know that you
Yes,
are. It's
we
a
are.
recommendation in Share Advisor. So,
Correct.
okay. So before earnings, Nanosonics carrying a market cap of $840 odd million, and all of a sudden, after they've announced their earnings up to nearly $1 billion, what has happened to, all of a sudden, Nanosonic share price is worth 16+% more. What's the story there?
I'm going to do a very quick detour, mate, and remind our viewers they can leave their questions in the YouTube chat right now. So if you've got any questions or thoughts or comments, do that for us. So we'll get to those as we go through this chat. Nanosonics has been fascinating, Adam, because the results were, I'm going to say pedestrian. I don't mean that in a bad way. I just mean that they were reasonably flat-ish. There wasn't all that much going on. And yet the share price jumped. And I've used this line a lot. I'm going to keep using it probably for the rest of my career at the Motley Fool. We talk about earnings season, right? Now, earnings season is the month of August, the month of February. So all ASX companies, or the vast bulk, report their earnings. So earnings season, that's kind of how it gets the name. I haven't written this in a while, but I call it expectations season, because it's not really about what you did. It's about what you did relative to what the market expected. And so Nanosonics, sales were up a bit. Profit was up a bit. It was fine. It was nice. It was great. But the market expected worse. Frankly, the shares have been sold off before earnings on concerns about their ability to keep selling product. Now, they changed their distribution agreements. They were using a wholesaler that then went in-house. Hospitals around the world weren't buying as much stuff because, frankly, it's still hard to get an appointment with a hospital buying team when you've got, the after effects still, frankly, of COVID being dealt with. And so the market had kind of given up Nanosonics, not for dead. It was still expensive in a traditional sense, but it kind of ratcheted back its expectations, expecting declines, expecting tough times, and simply things weren't as bad as people thought. They were pretty good. They were pretty positive. I will get to why we like it in a second, by the way, but that is enough. So expectations season, it's not about the result. It's about the result versus expectations and the outlook that the company gives. And it kind of makes sense, right? When you're buying shares, if I buy shares today, I don't get the past. The past already happened. Right? I don't get that. I don't get the profits. I don't get the dividends from the past. All I get is what happens from today forwards, from today onwards. And so in that vein, if you think that through, it makes perfect sense. What matters? The future. So the outlook the company gives, hey, we think things are getting better. Add those two things together, and that's why we saw Nanosonics share price rise. Now, a quick comment on the company itself. It makes ultrasound probes for medical treatments. Not probes, disinfection for those probes. In the old days, you put the probe in some disinfecting solution, you try and get all the bugs off, then you use the probe again for another patient. Hospital-acquired infections, or HAIs, were the big risk, right? The disinfecting solution was fine, but not as good as it possibly could be. Nanosonics makes these machines called Trophon machines, is the brand. They use nanoparticles, hence Nanosonics, really, really tiny little liquid particles that coat the probes more completely and disinfect those probes more completely. So that combination means that Nanosonics machines are literally the gold standard. They are what the medical profession call the standard of care. In other words, this is the gold standard. This is the best that's available. And while ever Nanosonics retains that place, they're going to have more and more hospitals, more and more medical systems say, hey, we want the best option here. Why would we want more hospital-acquired infections? What should we use? And around the world, I would say increasingly, but for a long time now, years now, Nanosonics has been that product. And as long as it remains the standard of care, we feel really, really good about its prospects because it should be able to get more hospitals to use their products. And by the way, they sell the solutions that go in the machines. A solution as in liquid, by the way, not answers. The liquid that goes in the machines. And so you sell the machines, and then you sell the liquids that go into those machines for as long as the hospital is using that machine. So it's a wonderful business model. They're doing a great job. But in this case, as I said, the market was simply too pessimistic. We already had it as a buy at Share Advisor and other of our services at the Motley Fool. I'll give that one away. I'm probably not supposed to, but I will. It remains a buy for us because we actually think that long-term future is really bright. We looked through the short-term volatility and not, look, we weren't forecasting a result this half particularly or this year, but we're not surprised to see things return to normal. We expect better and bigger growth in years ahead.
Yep, and that's good news for Nanosonics. It's not always good news. There's another company,
Yes.
And full disclosure, I actually own Nanosonics shares, so I've got a smile on my face.
Well done.
However, another company which I do own shares in, which I know that you've been following closely, Johns Lynn Group, company about the same size, obviously failed to meet expectations during expectation season, down around 30% in the last couple of days. How can a company go from being worth $1.3 something billion to just over $1 billion in just a matter of days?
It's mad, hey? So, look, the first thing, again, as I start to answer this question, mate, the first thing I want to say is we don't take the Motley Fool, the share market, as a guide for the way we should think about these companies, right? We want to make the market our servant, not our master. And so, yeah, your question is good, and I will answer it. But in lead up, what I want to say is we don't take our cues from what investors or traders more often are thinking or saying about a company. What we're looking for is a business that we like, whose future we think is attractive, and whose share price is even more attractive relative to that future. In other words, we want to make money when the company does well and when the share price grows because of that company's success. That's what we're looking for. In the short term, again, I've already said the market responds to last year's results. Says, oh, that's what we thought. We thought something else was going to happen. It didn't. We're now going to respond. Our question at the Motley Fool is simply, and I wrote this in one of the updates today or yesterday, we simply say, right, do we think this business is bigger and better in 5 years' time? And if so, do we think this price is attractive relative to that business's future? None of that is, do we like today's share price relative to where it was yesterday? Or do we think the market agrees with us? Or what do we predict will happen in 3 or 6 months' time? We have no idea. One of the great things about the Motley Fool, Adam, you enable me to say, I don't know when I don't know. There are very few of our peers and colleagues in the industry who get to say that, right? Because we're supposed to sell certainty. At the Motley Fool, we get to be honest with our members, not that others are being dishonest, although you might draw that conclusion, to say, hey, we don't know. So let's get back to Johns Lynn. The business itself is, excuse me, it manages construction, normally repairs for the insurance industry. Now, that's going to be a pretty attractive place to be, we think, as a business. But there's two components to that. One is what they call business as usual, or BAU, you'll see in the write-up. The other is so-called CAT, or catastrophe repair. Now, business as usual means, the regular ongoing repairs that are required. It might be a bath that overflows, a hot water system that explodes, or whatever requires home insurance claims to be made. It's relatively normal, right? Someone's going to overflow the bath once every whatever period of time, right? Once a week or whatever it is. That's business as usual. And then the catastrophe business is every now and again, you get a big storm, a big fire, a hailstorm, whatever it is that happens, flooding. I will say I didn't use Johns Lynn, but out downstairs, our ground floor got flooded about 2 years ago. We've only just got that resolved, by the way, through our insurer, not through Johns Lynn. So when that sort of thing happens, it happens in large scale. It happens across a market, maybe a city or a town or a state or a region. And then that becomes an unusually large piece of work for a limited amount of time. So why do I make that point? Well, if you think in those two contexts, right? Business as usual, relatively flat, a little bit bumpy, but there or thereabouts. Catastrophes, big but uncommon. Now, last year, or so I should say, get my numbers right, in fiscal year 2023, so we've just finished 24, so the year before the one just finished, there was a lot of catastrophe business because there were a lot of storms. I think my hail damage, my flood damage was kind of included in that, right? Then in 2024, the year fiscal 2024, which finished on the 30th of June, there was less catastrophes in the economy, society, country, whatever you want to call it. So what does that mean? Well, it means that we all had less drama. Johns Lynn had less business. And so when you overlay the two together, you have this really nice kind of gently undulating base business and this really spiky up and down catastrophe business. In some years, you're going to have a heap of work to do. Other years, not quite so much. Now, I give you all this background to then make the point that the market somehow seems to forget that catastrophes are unusual. And so Johns Lynn said, hey, Our business as usual business was up, was pretty good. Our catastrophe business was down because there was less catastrophes. And the market kind of went, oh my God, who would have thought? I didn't realize that was going to happen. We better sell these shares off. Now, you can tell by my tone, I think it's a little bit crazy. It didn't take much thought, much investigation to realize that in good or bad years, good years for John Zling, you're going to do much better business. When there's no catastrophes, you do less business. That shouldn't have been a surprise to anybody. And so honestly, mate, as much as I've done this thing for a lot of years now as an investor and as an amateur professional investor, I still sometimes shake my head. I don't know what the market actually expected. That is, did they think that there were some catastrophes that we didn't know about, or somehow Johnson was going to make up this business they couldn't have otherwise covered because there were no big claims to be resolved, to be built? And the answer clearly was no, of course not. It was knowable and known. You didn't have to forecast it, right? It was known the catastrophe business was smaller, and yet that seemed to surprise the market. Now, is it possible that the market had paid too high a price in the past because it had extrapolated that catastrophe business forever and said it'll always be this good? Maybe, yeah. It's not impossible that we all paid too much, including we recommended it at Share Advisor, and you own some shares. Maybe we all paid too much for these shares because we kind of took the high numbers that that's going to be the case forever. I don't think so, by the way, but it's possible. What I think is more likely is the market overreacted to some short-term volatility and lost its, stuff. Let's say stuff. We've seen this a lot, and I think this is why it's a really important. I'm glad you asked about this one, mate, because there's a teachable moment here. Anyone watching this, I hope what I want you to get out of this is as investors, we have to think about volatility. Would we really have preferred they not do any catastrophe business so the business would be flatter and somehow, a nicer, straighter line? I mean, you'd be mad to say that, right? If it was your business, you wouldn't say, I don't want that. I don't want the catastrophe work, thank you, because I might not get it next year. Of course, you'd say, I'll take that. Yeah, absolutely. You're going to throw millions of dollars at me worth of work. Yes, I will take that. Next year it won't happen, but that's okay. I can manage for that. And yet at a market level, at an investor and trader level, people forget that way too often. The market really overreacts to volatility in both directions, by the way. So keep your eyes on that. John Zling's business, underlying, perfectly healthy, perfectly fine. I suspect it will continue to grow. Increasingly, insurance companies are not repairers. They are running financial models and doing marketing. They're outsourcing the repairs to somebody else. John Zling does a wonderful job of that. I suspect they will continue to do a wonderful job of that well into the future. Now, no promises, no guarantees, right? I could be entirely wrong. But our expectation is that John Zling will continue to gobble up market share because they're providing a really important service to those insurers. Will it be volatile? Yes, because I don't know when the next storm's coming, and neither do you. But over time, if they keep gobbling up market share, keep providing great service to insurers, I think the future is pretty bright for John Zling Group.
Yeah, absolutely. And thanks, Marcello. I've put your comment up on the screen because it really sums up our investing philosophy here at Motley Fool very succinctly, probably more succinctly than even we can do. Another comment, and this is a good question. Sorry, Scott, that's a bit of a statement.
I got that. Don't worry, I heard you.
Has been known to be a bit verbose, but he's at least he gets it all in there. So this is a good question from TC in the comments as well. We're at all-time highs right now. Explosive PEs, Mr. Market now demanding for some of the more quality businesses. Should you be trying to time the market and sort of pull money out when we're at all-time highs like we are?
So no, but maybe yes. And I'll try and be. Adam's giving me a challenge here to be less verbose, so I will try my best. And then Adam's going to sing and dance for the last 25 minutes. No, I'm kidding. Don't time the market. Don't time the market. Think about all the best businesses of the last 25, 30, 40, 50 years. When was a bad time to own Amazon, I own shares, or Apple, or Nvidia, or Facebook, or choose your preferred company? When was a bad time to own the best companies? Almost never, right? Even if there were highs and lows and highs and lows, they go higher over time. And trying to guess or speculate or judge the best time to get out, then back in, then out, then back in, really, really, really tough. That being said, the basis of your question is if they're priced for perfection. Now, at that point, yes, absolutely. If your companies are overvalued, if they can't possibly achieve what the share price requires of them, then yeah. If the market's offering you a stupidly high price for a business that is fine but not that good, then take the money. If someone knocked on my door tomorrow and said, Scott, I'm going to offer you $5 million for your house. Do you want to take it? I'm like, I will drive you to the bank and collect the money in cash right now. Let's do this deal. Why? Because it's a stupidly high price. If they offered me roughly market price, even 20% more than my house is worth, would I take it? Probably not, because I kind of like my house and my wife likes our house and we're happy here, and I probably wouldn't take the money. So if you're offered a stupidly high price, you're not trying to time the market. You're just saying, you're offering me what? Of course I'm going to take that. If Commonwealth Bank's share price doubled tomorrow, I don't own any shares. I would sell in a heartbeat, right? Not because I'm timing the market, just because it's a stupid price to offer. And so, of course, I would take it. You mentioned Mr. Market. That's exactly the right point, TC. Mr. Market is irrational, right? If Mr. Market offers you a stupid price, take it. On the flip side, if they offer you a stupid price to buy shares, stupidly low, take that as well. But please don't try and time the market. I can't give you advice, TC. Obviously, you know that. This is general advice only. But other than that, have a look. So I talked about the 5-year view. So here's the simple reality, right? I look at all the companies that we recommend, all the companies I own personally, which is about 95% of my portfolio is companies we've recommended. And I say, right, do I think this business is going to be bigger or better in 5 years? Some have already said this. Yeah, I do. Is today's price attractive for that? Yeah, it is. Now, if it's only barely kind of fair value, I'm not going to rush out and buy more, but I'm probably not going to sell in a hurry either. One of my favorite lines I think I came up with, but someone else might have done it first, is I'm slow to buy and even slower to sell. Why? Because I've got the buy decision right. If I found a great business with good management, a great business model, competitive advantages, attractive price, bright futures, all that stuff, do I really want to get rid of it a heartbeat and try and get something else, or just sit in cash? Probably not. The market goes up over time, not down. Now, I don't know where the market goes next. If we'd have done this, by the way, this Motley Fool TV, 27 days ago, when the market fell, 5 or 6% in a couple of days, everyone was telling me on Twitter and email and everything else, oh, then there's the crash coming. This is going to be terrible. This is the first day. Don't buy now. You'll lose your money. Now, we know for a fact after that it went up. Might not have, but it did. The market goes up more often than it goes down. It goes up further than it goes down. If you're being up a stupidly good price, take it. If it's just kind of, if you like the business a lot, you think it's a really high quality business, if it's got a really long growth runway, if it can grow for years to come, and it's there or thereabouts price-wise, I would be personally really reluctant to sell. Let the business have enough rope. If it's good management team, good business, competitive advantages, great brands, great customer base, recurring revenues, all that kind of stuff. And maybe one day we should do one of these deep dives into some of this stuff, Adam. But if you got that opportunity, be very, very, very slow to sell those sort of businesses, because they tend to surprise you on the upside.
Yeah, and last month we were talking about CrowdStrike because they committed a tragic faux pas and destroyed the internet for a day and a half or something. Since then, they're up 23%, and they're basically back to where they were 12 months ago, and everyone's forgotten all about that.
Exactly, that's a great
staying
point.
in the US, yeah, that's right. Staying in the US, this is a good question from Hassan. So, look, obviously all eyes are going to be on the US interest rate announcement next month.
Yeah.
The Fed Chair, Jay Powell, signalled last week very strongly that the Federal Reserve is going to begin cutting interest rates in September. It's been a long time coming. Firstly, is this the turnaround we've been waiting for? But as Hassan asks, does that make the Australian market less attractive than the US right now?
Oh, great questions. So funnily enough, it was the US cutting rates that actually sent the US market off a cliff for a couple of days, right? And what was great about this was I think it was Wednesday night our time from memory. Powell came out and said, yeah, we're going to cut rates. And the US market was up more than 1%. So I woke up to news of, he's going to cut rates. This is great. Company's going to be worth more. We're off to the races. Debt's going to be cheaper. This is wonderful. And the next day we woke up on a Thursday morning and everyone was like, oh my God, he's going to cut rates. This is terrible. The market must be tanking. The economy's in trouble. Let's sell everything. And honestly, if that doesn't remind you not to listen to the market and let the market tell you what to do, I don't know what does. It was just traders on one day, super excited, a good night's sleep or maybe a bad night's sleep. They woke up the next morning absolutely pessimistic and fearful. And that's why we saw the big falls over the following couple of days, or 4 days, I think it was. The US will probably cut rates. And it'll probably cut rates because they feel like inflation is under control or getting that way. And there are risks to the downside on the economy. There are risks that the US does go into recession potentially if they keep rates higher for longer. So Jerome Powell's going, you know what? We reckon it's okay now to cut rates. Take a bit of the foot off the brake, not entirely, just a little bit, and let the car coast a little bit more quickly. That's kind of what he's trying to do. And that's probably a good thing. We saw Australian inflation out today, by the way, at 3.5% on the monthly read, which is still way too high, but coming down at least over the last couple of months. So that's a win. Does it make Australia a less attractive market? I don't think that follows necessarily, mate, because, again, it comes back to the why. If the US is cutting rates because the US economy is in trouble, maybe that tells you something about the US earnings power, right? Or, as you rightly probably assume, Hassan, it also could mean that equity values are higher. Now, I'm not going to go into the maths because no one wants to do that on Wednesday night, but effectively, the lower the interest rate is, the higher the share price can be. When you do the finance algebra, that's kind of what comes out. The lower the interest rate, everything else being equal, the higher the share price. So would we expect share price to go up in the US as a result? A little bit, yeah. But remember, the share price is the price divided by the earnings. That's the PE ratio, right? If earnings are not going to be as strong because the US consumer isn't spending, US businesses aren't spending, lower rates can only do so much of that heavy lifting for you. Rates go down by 0.25%, profits halve, you're still going to get taken to the woodshed. So just be a little bit careful that we don't get too macro. And I've got to say, we're not really, for all the time we spend out talking about the macro, why do we do it? Because you ask about it. We do it because it's important for us to provide a perspective on what otherwise is being talked about by everybody else. But I've got to say, at the Motley Fool, man, if 5% of our time is spent thinking about the macro when it comes to investing, that I'd be remarkably surprised, almost certainly less than that. We are bottom-up investors. We look at the businesses themselves and the long term, right? Here's the other thing. You ask about attractiveness of the markets. We're investing for 5+ years. So over that 5 years, I suspect, if I'm right, rates will come down, start going back up. They might even start coming back down again by that point. I don't really know. So that's kind of the point, right? That being said, if I find the next Apple, the next Berkshire Hathaway, I own shares in that, the next Nvidia, the next CrowdStrike, as Adam mentioned, that's going to do all the work, right? Does CrowdStrike share price really depend on interest rates? Nah. Does Nvidia's? No. Does Apple's? No. It is the business itself. And so my encouragement to anyone watching is please don't be distracted by the macro. Is it important? Sometimes, yeah, depending on the business and how much debt it's got and all that kind of stuff. But the long-term returns are not going to come from the fluctuation of interest rates. They're going to come from the returns of the businesses themselves. So, Hassan, to your point, to your question, it doesn't change my view at all. I think there are some fantastic businesses here in Australia. There's some fantastic businesses in the US as well. We have a service, by the way, called Stars and Stripes. Not very imaginatively named, although I did come up with the name. It's basically a US-based service, right? So Australian investors who want to invest in US companies and want us to help them advise on that, it's what we do. And Chris Copley, who runs that service for us, is doing an amazing job. Really great investor, really great process-driven guy. I personally believe you want access to the US market. I think about half my money, maybe a little bit more than half, is invested in US equities, either on the ASX or directly in the US itself. Find great businesses, buy great businesses, hold great businesses, let them do their thing.
Yeah, absolutely, and own businesses listed in the US. I forget the stats, Scott. We surveyed our investing team and asked, okay, how many of, what percentage of your portfolio, your personal portfolio, is based in US shares? It was a 60, 70 plus, was it?
Yeah, I think it's about, I have it was 60 something. For me personally, well more than half of my portfolio in absolute dollars is invested on US markets directly. And I also own a global ETF and a NASDAQ ETF. But between the two, well more than 60% for me, probably closer to 70 plus, I would suspect. And about 60 for the rest of the team, yeah.
Yep, I'm about the same. And look, when you see the Australian dollar going up a few percentage points, it can kind of remind you, hey, now is a great time to buy. Not because of that, because it's always a great time to buy. But if you're just contributing money generally, then yeah, you can take advantage of those little swings in the Aussie dollar-oo as well.
Absolutely,
highly recommended. Question from Lewis, mining companies, your favourite. Lewis has been watching the Fortescue annual report tonight. Obviously, that wasn't interesting enough, so he's switched over to watch Scott and I instead. At what point would we recommend a mining stock, Scott? This is a question I'd like to know as well.
This is great. I own shares in Fortescue, for the record, but I've never recommended them to our members. Why? Because to my mind, it was too speculative. Mining is really hard. Mining is really, really, really hard because I don't know anyone who can reasonably forecast over the long term. We're long-term investors around. We're not short-term traders. The value or the price of a given commodity. What will the iron ore price be in a week, let alone a month, let alone a year, let alone 5 years? I got no idea. Why? Because you've got demand And the thing that everyone forgets about, supply. So we've seen it with lithium. Everyone rightly said, you know what? I reckon the EV market is going to boom. Home battery is going to boom. Everyone's going to be using lithium. That was 100% correct. What happened? A whole lot of miners said, I'm going to take advantage of that. I'm going to mine lithium. So what happened? Well, for a while, demand outstrips supply. Economics 101 or Year 8 economics, when demand outstrips supply, what happens? Prices tend to go up. When supply catches up, what happens? Prices come back down. Even if demand doesn't change, demand can keep increasing. But if supply catches up and stays at that level, you're going to have lower prices. I've given this example before. Over the 20th century, I had some very back of the envelope numbers. A few years ago, 4 years ago, maybe now. The oil price went up 2.5 times over a century in real terms, that is after inflation, even allowing for the fact that 1900, we drilled no oil at all. We used whale oil. By 2000, we were doing millions of barrels a day. And yet the price only went up 2.5-fold. Why? Because supply caught up with demand and kept prices reasonably stable. Take you back to mining. The challenge for us is how much iron ore is going to be used in the world in 2029? I don't know. How much is going to be mined in 2029? I don't know. So you've got Fortescue, BHP, Rio, Vale in South America. Probably going to keep mining, probably more over time. You've got China investing heavily in Africa to try and create an iron ore market there. Why? They want to drive prices down. Now, I'm not saying they will. I'm literally saying I don't know. When you're investing, you want to find bets that you think have a higher probability of outcome than the odds you're offering. In other words, if someone's offering you a 2-to-1 deal, you want better than 2-to-1 odds of a win, and that's how you make money. That's how you make excess returns. So when you think about the mining companies and the mining industry, you've got to know the business itself, the operational excellence or otherwise of that business, its ability to stay in business through fluctuations of prices. Take Santos in oil, almost went broke a couple of times. Why? Because the oil price dropped. It was a high-cost producer. Now it managed to get itself through it, raise some capital. It still exists, but not as good shape as it was. So we don't know how much you'll produce, what the cost of that production will be, what other competitors will do production-wise, what the demand will look like. I'd rather look at a business and say, I think that business has a great competitive advantage, a great moat, some recurring customers, ongoing use. I can so-called industrial companies, non-mining companies, they're just simply more understandable. And the future is more, it's not knowable because no one knows the future. The range of outcomes is much smaller. So it's likely the biggest gains will be made over the next 10 years in mining companies. But which ones, in which commodities, over what period of time, I got no idea. And so if your job as an investor, my job as a professional investor, is to find companies I think are probabilistically likely to do well, likely to beat the market, I want to start with a company I can understand, whose industry and category I understand, whose future I can have a reasonably good stab at. Again, no promises, no guarantees, but I'm looking for those attractive bets. When the market says, hey, here's a stupidly good price, as in cheap price, for a great company, that's what I want. BHP's done really well. Why do I own Fortescue shares? Because, and here's the answer to when would we? I don't know. By the way, tell us what they have to do. We have a house style of investing. We don't have a house view on any stock. Tomorrow morning, someone could release a recommendation on a mining company. That'd be completely up to them. I don't vet that. I don't tell them they can or can't do it. But generally speaking, our style is companies over 5+ years that we think have a really good chance based on evidence and analysis of being market beaters. When I bought Fortescue, and by the way, I've screwed this up myself, by the way. I bought it when the iron ore price was at a cyclical low. And my view was, Twiggy's a smart guy. The iron ore price is low. The Fortescue Future Industries, their energy business, I thought had some pretty good upside potential. I wasn't paying much for it. So I was like, you know what? I'm going to have a flyer on this. So why I didn't recommend it to our members, because we don't do that in our services. The ones I run, Share Advisor, Everlasting Income, Motley Fool Odyssey, Platinum, we don't do the kind of, take a flyer on this. And I couldn't have looked our members in the eye and said, yeah, this was on very fundamental bases, this was worth buying. I did it with a small amount of money in my own portfolio because I thought it was probably attractive. Now, I was right for a while. Went from $17 to 30. I look like a genius. I know what it is now, but it was back at $17 not long ago. So goes to show trying to trade iron ore is a crazy, crazy thing to try and do.
All right, so let's stick to what we know then. And one company you do know very well, Scott, is Soul Patts. So Simon's asking, can we help him understand the announcement relating to the convertible notes? What are they, and what does that announcement mean?
Convertible notes. Let's get into some arcane accounting on a Wednesday night at the end of August. A convertible note, so a note is a loan. These are all, I've got to say, the finance industry really doesn't make it easy, right? There's bonds and there's notes and there's loans and there's deposits and it's kind of the same thing depending on who owes what to who. Excuse me. Soul Patts has said, we want to raise some money. We want to borrow some cash. And what it said is, we want to borrow some cash. We'll find a lender. I think it was Singapore from memory, maybe in Hong Kong. I think it's Singapore. And the deal is the interest rate's really, really low. Why? Because the person who lends the money to Soul Patts may, under certain circumstances, get shares instead of its money back. So it converts, the loan converts to equity. The debt converts to shares. So convertible, that's the idea. The note just means loan. It's just a silly way of describing a loan. There are some very arcane specific terms and conditions, but effectively for our purposes, it's a loan. So Soul Patts kind of says, hey, we're going to borrow this money. We'll borrow for a really cheap price. If you want to, or they want to, depends on the terms of the note, convert those to shares, you can have the shares instead of the cash back. And that's all it means. For investors, if Soul Patts gets this wrong, I don't think they have, by the way, you can let the lender, in other words, the Singaporean funders, convert that debt. So I'll lend you $100. I can then have, instead of my $100 back, 5 Soul Patts shares. Now, at the moment, Soul Patts shares are worth $30-something. So 5 Soul Patts shares be worth more than $150. I only lent you $100. So the lender wants the upside, wants to convert them. The borrower, Soul Patts, wants to have the lowest interest rate possible. It's the job of Soul Patts to make sure those terms are done in the best interest of Soul Patts shareholders. That is, make the terms relatively less attractive for the potential lender to convert those shares. The lender wants to convert them at a good price. They want the upside of the share price gain. So if you're the Singaporean investor, you're saying, well, I get my money back plus interest, and I get the potential upside of the capital gain on the share price. That's why they're doing it. Soul Patts says, well, if you get the upside, I've got really cheap money because I borrowed effectively at a $30 share price. If the share price is $50 in 5 years' time, well, you get those $50 shares, but I got to lend the money when they're only worth $30. So we spent an hour and a half on convertible notes. That's the basic idea. Is Soul Patts dangles a carrot to the lender and says, give me a better interest rate, you might get some upside from the share price. The lender says, I'll take the money, I'll get my capital back, and I get some upside potential. That's why that deal gets done. Now, it's got to be attractive enough, otherwise neither party would do the deal. So both parties in this case think it's a reasonable bet. Soul Patts is a very, very reputable borrower. They will pay the money back. No worries about that. So there's no risk. Well, there is, but in the real world, there's no significant risk for the lender, and they get some upside potential. Hope that makes sense.
Okay, so we have a couple of questions about a couple of smaller companies. I'm not sure how closely your team's been following Drone Shield lately, Scott, but obviously Drone Shield share price has taken an absolute hit lately. Do you have any thoughts on Drone Shield? Is it investable now? Is it a good buy now?
I have thoughts on Drone Shield. The share price is halved. In fact, it's more than halved. This share price was, let me do the numbers. It was almost exactly $2.60 in July, right? What is it? A month later, it's the middle of July. A month and a half later, $1.28. Now, depending on where you bought the shares, they were $1.01 in August, and they were 28 cents back in October 2023. So have you done well or badly? It depends when you bought and what price you paid.
Yeah, no, and obviously the Ukraine conflict was a massive input into that.
Correct.
And I don't even know if Drone Shield is supplying. I'm pretty sure they are supplying equipment. But yeah, that's the kind of thing that people put 2 and 2 together as a small cap company, and the share price blows up pretty much based on speculation that a weapon that's capable of destroying drones out of the sky must be good for the world when there's a big conflict involving a lot of very small drones. It seems to be that's what has driven it up. So it would be the case that it's probably just brought it back to a more sane share price now.
Spot on. This is the absolutely typical quote story stock. This is when people lose all perspective on the underlying fundamentals of the business and say, drones, Ukraine, weapons. Hey, we're off for the races, right? It's a lithium story all over again. Would it be cool if there's something that could blow drones out of the sky? Yes. Oh, DroneShield does that. Cool. Let's pay any price for the shares. Now, even after it halved, mate, this is a PE of 65 times earnings. Now, I don't have to be a genius to do the maths. That means at its height, it was 130 times this level of earnings. Now, Amazon has been stupidly valued in the past. So it's not, I'm not saying it was a stupid price to pay, but that excitement, that carry on, that kind of, and the other thing is when a share price goes up, and it went up really quickly, it was 90 cents in May and $2.60 by July. I mean, we're literally about 2 months here. People got carried away, which doesn't mean it can't go back there and higher again. This might be a $5 stock next year. And in fact, it might be a $100 stock in 15 years' time. I don't think it's likely, but it's possible. So again, we're looking at share prices and saying, what does that tell us? It tells us how markets thought at a point in time. It tells us nothing about the value of the company, right? Was it ever really worth $2.60? I don't know. Is it really worth $1.28 now? I say I don't know again. Not because I'm trying to avoid answering the question, but because the future is not yet written. If DroneShield does become a major military supplier to the world's militaries, then there's really significant upside here. If, for example, though, it remains a bit player and there was simply too much carry on, then we will look back and go, cool technology, cool company, has a role to play, but I was probably a little bit optimistic to pay 130 times earnings for a company like DroneShield. And that's kind of where you're at. I talked before about buying for the 5+ year horizon. If you think this company's going to be 10 times bigger in 5 years' time, who cares the price is halved? I mean, you do, and I do. If I owned them, I feel poorer. But if this is a $10 stock in 5 years' time, this is just noise. Now, if it's a $1 stock in 5 years' time, it's still just noise, but it's telling you something. The noise will be very, very different, which is, gee, we got carried away, didn't we? And so you've got to try desperately to put the share price movements out of your mind. Is it up? Is it down? Who cares? Is it doubled? Is it halved? Who cares? Your only question, this is really easy for me to say, hard to do, particularly if you're a new investor or a relatively inexperienced investor. You look at the share price halving and you feel sick to your stomach. By the way, if you owned it 6 months ago, you saw the share price go up threefold and you felt like a genius. Neither of those things were true, right? It's just what the market had said it thought it felt, not even thought, felt at the time. I was really excited. I'm really pessimistic. I was really exuberant. I'm really fearful. That's kind of what we're seeing. That's what share prices tell you is how people were thinking at the time. Over the long term, Ben Graham told us almost 100 years ago, Warren Buffett's mentor, over the long term, price will follow value. So your question as an investor is this a bigger, better business in 5 years' time? If the answer is I don't know, you probably don't have any interest owning the stock. It's a lotto ticket at best at that point. But if you say, actually, I've done the work, I've done the research, I think DroneShield gets a lot more of these things in 5 years' time. The market's going to get bigger, more military, more countries want this stuff. They can make it really quickly. I can see then it's worth buying at $28. Or you might look at that and say, well, I love the tech, but gee, I don't really have a high conviction that it's going to happen. I mean, I hope it does, but hope isn't an investment strategy. So I'm not really sure. I'm not sure I'd buy it at $28 because I don't really. This is a $1.13 billion market cap, by the way. Am I really sure it's worth that much money? Maybe I'm not. Okay, so maybe I don't buy the shares. If I own them, maybe I sell them. But that's the lens. Don't worry about the share price. Halved, doubled, who cares? Some both, by the way. Some more than that over the last 12 months. Halved for some people, doubled for others. Doesn't matter. All that matters is what happens from here, from today's share price, looking out 5+ years. That's the question you need to answer for yourself.
All right. Now, another company which I'm not sure that you'll know of, Scott, SNL Supply Network Limited. So this is a company that provides, so Multi-Spares is their brand name, providing aftermarket parts for trucks and buses. Now, before you answer, Scott, I do have to tell you, Arthur, not many things upset Scott Phillips, but the one thing he doesn't like is people using ticker codes instead of company names.
Exactly.
We're talking about companies here that have real people doing real things, making real money, not just charts and ticker codes and indicators and all of that all of that hocus pocus. We look at fundamentals here at Motley Fool Australia. So, Scott, what do you think of Supply Network?
You're stealing my rants, and I suspect that's because you don't want me to go on a rant by myself because it'll be 5 times as long.
I wanted to have a go for a change.
Good idea. Join the club. It's much more. It's cathartic. I love Supply Networks as a business. It is a really, really, really attractive company. It's done an amazing job. I have a feeling it might be a recommendation for at least one of our services. I'd have to check that. Not one I run, but one of the other guys. It has had a really great long-term success story. It's grown organically. It's grown by acquisition. Consolidating a fragmented industry is a really, really attractive business. Think about the banks 30, 40 years ago. They're all smaller, buying up the little guys, putting little guys out of business. Think about Woolies and Coles. I'm old. I used to work for Woolies at one point. I worked for suppliers at one point. Woolies market share, I want to say 30, 40 years ago, I'm dating myself, might have been like 20%. It's now 45+% in dry grocery, the kind of middle of the store, not necessarily in the total grocery market. But when you consolidate an industry, they bought Fleming's, Franklin's went out of business, Jules went out of business, Wiseau went out of business, plenty of brands you'll know and love and are no longer around. As they consolidate the industry, when you grow from a smaller player, you get something right. You get the business model really right. And what do? You kind of Pac-Man the industry. You either buy the competitors, you put them out of business, you take market share, you just grow and grow and grow and grow and grow. That is a really, really attractive way to grow as a business. And as an investor, they're the sort of companies I love finding, right? The ones that are smallish, but doing something really right and just continuing to take market share. That's the Supply Network story. It's done a really fantastic job. The question for investors for Supply Network, I mentioned high PEs before. This is on a PE of 40 times. Now, the average for the market's about 15 over time. So you're paying, 3.5 times as much for this? Or sorry, 2.5 times as much for this? That's a lot to pay. Let me throw myself in some mud for a second, Adam. I recommended to our members, I made a mistake. Recommended Coca-Cola Amatil, the local Australian Coke bottler before it was bought out by the European bottler. And I got the analysis entirely right, except for one thing. There wasn't enough growth left. So I went, it's Coke. It's in every fridge in the country. It's dominant. It's ubiquitous. It's got the biggest distribution network. And I was 100% right. All those were absolutely true. Problem was, couldn't grow fast enough, couldn't go far enough. Because why? I just said, it's in every drinks fridge in the country, every servo, every general store, every vending machine, it's got Coke in it. So where's the growth come from? Little bits of growth. I mean, it wasn't going to be flat, but there's only little bits of growth left. It already maxed out the growth potential. Woolies and Coles, which are about the same position right now. So I got that horribly wrong. I didn't lose a lot of money, but the upside was tiny, and we sold, I think, maybe for a small gain, but it was market lagging. I missed the fact there wasn't enough growth left. So the question for Supply Network shareholders or would-be shareholders is there enough growth left? If the long-term P is going to be, say, 15 times, it's got to probably go 2.5x its profit. By the time it gets to that, it'd be 15 times at the current share price. So how much is left? I am cautiously optimistic on Supply Network. Not a recommendation of mine. I don't own the shares. But David Gardner, the Motley Fool co-founder, has a great saying, very simple, sounds almost too trite to be true. Winners tend to keep on winning. And if you kind of take that view, if you're small enough, there's enough growth left, you wouldn't bet against a business with the track record of Supply Network. So would I buy shares tomorrow? I don't know. I mean, I haven't, so maybe that's your answer, right? I don't have enough conviction to buy shares myself. I definitely wouldn't short it. If I own the shares because I had that conviction, I wouldn't be selling. Just know that there's a lot it needs to do to justify the price. It might be volatile in the meantime. If it misses a couple like Nanosonics or John's Ling, if it misses expectations, it might be pretty volatile on the way through. But if it can continue to grow, and I wouldn't bet against it, Supply Networks could do well from here.
Very good. Okay, so now we've got Paul asking about Zipco. And who'd have thought we'd be back on the buy now, pay later merry-go-round? To be honest, I really would have thought by now that this, it would have been legislated out of existence if you look back several years ago when we were all excited about Afterpay. Paul's asking especially, is it justified given the anticipation about rate cuts in the US?
You know what's really funny about Zip? I just looked at the graphs. Over the last year, Zip is up 600%. You've got 6 times your money, right? Which sounds amazing. Over the last 5 years, it's down 30%. So both are true. And in fact, the $2.38 share price was $12.35 in February 2021. And that's kind of the challenge. I think, again, both are true, right? Neither is right or wrong. That they're both, the data is the data is the data. That's what's happened. What you're finding, though, is there's a real concern. I can't pay $3.1 billion for a company that's not making profits, particularly in this space. Your point about legislation, Adam, is right. The federal government's actually already, I don't know if it's been enacted yet, but it's very close to legislating rules to effectively bring buy now, pay later back inside the credit code. It was a loophole. The loophole was there. Governments, in their wisdom and I would say folly in the past, from a consumer protection perspective, simply said, well, it doesn't charge credit, so let's pretend it's not a credit product. Of course, it's a credit product. And so they're fixing that now, but later they should have 5 years ago. They're doing it now. Not because I hate, well, I do. I don't hate the companies. I don't want people to lose money. I think they are not great financial products for anyone. We do a bit of personal finance, mostly investing. I hope no one uses buy now, pay later, other than if they're going to pay it off in full at the point in time. We know too many people, something like 20 or 30% don't. So I don't like the product. It's going to be legislated much more severely in Australia. The question about is the US its future? Maybe, yeah. This is, speaking of story stocks, this is one where hopes have been raised and dashed and raised and dashed. I'm not going to give you a prediction of what happens next, but I'm going to say I'm not going to pay $3 billion for a buy now, pay later company with no profits, given the regulatory risk, given the potential for other players to do it. One quick, excuse me, a line I like is, when your product becomes someone else's feature, you're in trouble. Think about digital cameras. Think about radios. Think about, the things that, now in a phone, right? Where's my phone over here? When your product becomes someone else's feature, you cease to have a product. Banks are already offering buy now, pay later features. PayPal, I own shares in PayPal, offering buy now, pay later features. American Express is now offering a plan, I think it's called Planet, where you can take your balance, you pay it off over time. Maybe these guys remain separate. Maybe they remain standalone. Maybe they've got something to offer. I very much fear that if the concepts is sustained, it'll be provided by mainstream financial players, not by standalone individual businesses like Zip. But I could be wrong, but I wouldn't be buying the shares today personally.
All right, so we have a really good question. Another one from Lewis. What are your thoughts on diversification via sector? Would you rather buy your best idea each month, irrespective of sector diversification? Hang on, let me throw that up on the screen. Or would you keep a degree of portfolio balance? Look, I'm guilty of doing this. I'm guilty of every month when I've got my leftover cash, if there's enough to buy a decent tranche of shares, I'll buy my most exciting, the company that I'm most excited in at the time. And you end up with a bit of a mess of a portfolio if you work that way. Yeah. So what's your solution to this, Scott?
When you do this for a while, you kind of have these little sayings you kind of go back to, and hopefully they're useful. What I say to people is, you're not Noah. You don't need two of everything. So I like diversification, but not for its own sake, right? Don't buy two airline stocks. That's a terrible idea. I wouldn't buy two miners. We talked about mining earlier. Why? Because I just don't know that I have enough conviction to believe they're going to beat the market. That being said, to your question, Lewis, diversification is really, really, really important. You don't want your portfolio to be torpedoed by one or two or three specific risks that you could have avoided by buying other stuff as well. Now, I'm not saying buy rubbish because your single best idea, you've got too much of it, right? You've got to draw a line between the return you're likely to get and the benefits of diversification. But I have to say, there are 1,500 odd companies on the ASX. There are 3,000, I think, in the US. There's plenty of great businesses out there. I've heard people say to me before, I own all 4 banks. That's diversification, isn't it? And I have to gently tap them on the shoulder and say, nah, you need to think about that again. Diversification is about sector either, by the way. It's about exposure to specific risks. Here's a great example. So take the tech sector, right? It is the biggest misnomer in investing, tech sector. What is the tech sector? Well, it's Amazon, which is really a retailer. It's Apple, which is really a consumer products maker. It is Cisco, which actually makes switches. It is, I'll use Australian company, Technology One, which makes enterprise software for government and council and education facilities. Now, that's all tech. But what do they actually have in common? I mean, maybe Apple and Amazon have a similar-ish trajectory if consumer spending falls off a cliff, but Cisco is fine and Technology One's okay, and yet it's all tech. On the other hand, retail is absolutely going to be, retail is retail. If you said, I want to be diversified, having 2 tech companies, Amazon and Cisco, for example, or having a tech company and a retail company like Amazon and I'll say Kogan, I own shares in both of those. Are they retail or are they tech? Well, they use technology, but they're really retailers. So think a bit about don't think about the sectors at all is my advice. Think about the risk factors that come to play in those particular companies. What is it that's going to bring them undone? Think about, one of the simple ones is debt, right? You can have companies in very, very, very different sectors, but if they've all got a mountain of debt and either rates go up or business suffers for a little bit, they can go broke, just not being able to pay the bills. It's nothing to do with the sector they're in, nothing to do with what they do or produce or even who their customers are. Just they've got too much debt. So debt is a risk factor. Consumer spending is a risk factor. How much of your portfolio is aligned to that? Think about property prices. What does that mean for banks or for builders, for example, or for real estate investment trusts? They are much more aligned and much more similar, even though they're in 3 different sectors in theory. So don't diversify by sector. Diversify by really think about what could damage this business, what could break this business. Those factors are what you want to diversify, not an arbitrary sector, particularly not tech, but even just across anything else. Again, as I said, companies in different sectors can have very, very, very similar or identical risk factors, in which case you're not diversifying by having separate ones compared to, for example, 2 companies in the same sector that are very, very different. Even in retail, think about Woolies or Coles. They reported this week. Compare that to a discretionary retailer, JB Hi-Fi. Woolies and JB Hi-Fi are both retailers, but their futures are very, very, very different. The risk factors are very different. We're always going to buy baked beans. We might not buy as many computers. Think about going online. Who's going to win the online race? Is it JB? Maybe. Is it Woolies? Maybe. But think about that risk factor as well. So keep that in mind rather than just using sector or style or type or any of that kind of stuff.
All righty. Now I'm going to give a bit of a priority to a specific question about people in, because it's one that we've been following. It's a rec. Question from Luke and Jade Munro. It's had a 50% drop since a recommendation in Share Advisor.
Yeah.
Do we still have a long-term conviction?
Great question. People in does staffing. So think about contract labour. What happened with people in is the government changed the law. They have this same job, same pay law. That means the big miners in particular, but cleaning companies as well, airlines, nursing staff. What businesses have done up to this day is said, actually, I can grab a contractor. They don't have to pay them the same rates. They're not full-time employees, so I can let them go at a moment's notice. Businesses want the flexibility of having a contractor rather than a full-time employee. If they don't work, if they suck at their job, if they've got bad attitudes, you can flick them because you don't want to have them come back tomorrow. With an employee, you've got to deal with all that sort of stuff. If business starts to falter, you can lay contractors off much more easily than staff, all that kind of stuff. Super, super flexible. Union said as a result, actually, hang on, you guys are taking the mickey here. We want people to have security. We don't want to make it too easy for business to flick people at a moment's notice. We want to make sure that people are treated respectfully and appropriately. And that's the tension that's been in place for a long time. The current government said we want to fix it. We want to stop that. We're going to make companies effectively treat contractors as employees, which reduces the value of contract labor. People in, that's what they do. So the market says, actually, this could really suck. This could be a tough business for people in. If this happens, they could be in some trouble. That's absolutely true. It's what's played out in the share price. Now, we knew that was going to potentially happen. We made the recommendation. And in fact, if you look at what's happened, the share price has fallen far, far faster than the profitability. We talked about some high PEs. People in's PE is 7.5 times earnings. That's a 14% earnings yield. That's a remarkably high number. Now, the market is betting the profits keep getting worse. So the question is, are we right or is the market right? I'll tell you in a couple of years' time. I don't mean that flippantly, but no one knows. We believe the current price is attractive relative to a probabilistic view of the future. And let's be honest, the view is really, the range of outcomes is really, really wide here. We could be entirely wrong. People in could go out of business, probably won't. It could have a decent chunk of its business go away because BHP and cleaning services and nursing services don't want contractors anymore. And people in's going, hang on, that's most of my business. Now what's left? That's absolutely possible. That's why we have risks in every one of our recommendations, right? We don't know what the future is going to hold. It's very possible that happens. I don't think it's the most likely outcome. And I also think there is enough in the rest of its business to make it worth today's price. The market disagrees with us. And we're back again to that question of don't let the market tell you what to think. Again, not because it's necessarily wrong, not because it's right. Ben Graham, again, I quoted him before. He says, you are neither right nor wrong because the market agrees with you. You are right if your data and reasoning are right. And that's what we're trying to do. Every time we make a recommendation, we say the market is wrong. Why? Because if the share price is going to go up faster than the market, in hindsight, we can say the market was wrong. Amazon shares, when they were $2 a share, they're now, whatever they are, 100 and something, $180. when it was $2 a share, there was a 90-fold increase, right? Someone said at that point, I'm not buying Amazon. That's a terrible idea. Turns out that person was wrong. Will people in return from this price and go higher? I hope so. That's the basis of our recommendation. We could be wrong. But every time you make a recommendation, every time you buy shares, you're buying off someone else. They're selling to you because they reckon that the price is too good to not take the money. You're saying the price is too good to not buy. That's always a disagreement right at that point, right? So every time we make a recommendation, every time we buy shares, we're saying exactly that. And that what we're trying to say is we believe on a probabilistic basis, it's more likely than not, the future is brighter than the market currently thinks. And if we're right, that's where the upside in the share price will come from.
All right, well said, Scott. And another comment that's well said, just for closing comments, Hal is saying it's awesome to get this type of access to Scott. I couldn't agree more, but for now we're going to have to wrap it up. We're at our hour.
Take it away
Time
from the
goes
people,
fast.
Adam. Come on.
That's no, that raises the point that if you do have any questions that you really want answered, I'll remind you that if you hit the Ask the Fool section on our member centre, ask us questions anytime. We often use questions asked there to decide what sort of articles we're going to put into the member centre, into various services as well, and we'll get back to you that way. If not, and if you can wait for another month, we'll be back here in a month. Look, if the demand's here, we'll make these live streams more often, but for now, that's what we're going to do. So thanks for your time, Scott. It's great that you have given up an evening to answer all these questions, and we'll look forward to next month.
Me too. It's absolutely lots of fun, mate. I would crawl over hot coals. It's some of the more fun stuff I do in my life. So thank you for the opportunity. Thank you for everyone for watching. We really appreciate your time.
All right, and we'll see you next month on Motley Fool TV. Bye.
Full on.